rat's hair above the level that will blow the bottom out of this market. And whenever we find a structure that's so clear, the momentum structure, so many hits on it, the ripe, we call that ripe, okay? Whenever you see a structure that's that ripe, it's intended for use, not some future date down the road, but it's now so ripe it's ready for use. We suspect it will be used this quarter and quite probably in the next few weeks. Once you break it, we declare we're in a major bear trend.
In today's episode, Michael Oliver shares his detailed analysis of an imminent stock market downturn, highlighting structural weaknesses across major indices like the NASDAQ 100. Drawing from decades of experience in momentum analysis, Oliver argues that the market has likely peaked and is teetering on the edge of a significant collapse. He points out that key subsectors such as small caps have already faltered, while the broader market continues to show signs of overextension. This fragility, coupled with record insider selling and historical patterns, underscores his prediction that a sharp market decline could occur within weeks. Oliver attributes the looming crisis to years of systemic economic distortions driven by artificially low interest rates and rampant monetary expansion. He describes the past decade and a half of near-zero rates as a drug infusion, distorting the pricing of money, the most essential commodity in any economy. According to Oliver, this prolonged manipulation has created a bubble far exceeding previous ones in scale and duration. While the Federal Reserve may attempt to counteract the fallout with rate cuts, historical precedent suggests such measures are unlikely to prevent a significant crash. As the stock market unravels, Oliver anticipates a dramatic shift in capital flows toward monetary metals like gold and silver, which he believes are poised for explosive growth. He also highlights the potential for related equities, such as gold and silver miners, to benefit disproportionately from this shift, given their undervaluation relative to both gold and the broader market. With the commodities sector showing signs of strength, Oliver advises investors to position themselves strategically in these assets, which he predicts will emerge as key beneficiaries of the coming economic turbulence. Before we dive into the best clips of the latest interview, make sure to smash that subscribe button and check our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest and most reliable service out there. Just a few clicks secures your data and keeps unwanted eyes at bay. Plus, if you're a stacker seeking truly independent market insights, visit goldsilverstacks.com for our Stacker's Handbook, loaded with strategies to safeguard your financial future so you don't rely on commentators for market insights. Enjoy the episode.
Well, we've had what we call, people like to talk about prior stock market bubbles. The 2007 high was a bubble, it was mortgage defaults and all that stuff. And then 2000 high was the dot-com bubble. And in 1929, of course, everybody thinks that was a bubble, and we collapsed to 1932, wiped the thing off the page almost, percent-wise. It took decades to get back to it. So those are things people call bubbles. But this bull market bubble that we've had since the 2009 low has been created by factors that are so bleeding obvious that when you go to the Federal Reserve of St. Louis and click through some charts, and I suggest looking at M2, for example, the money supply, and looking especially at the Fed funds rate chart, you'll see that we've had interest rates by the Fed, the short end of the market, near zero for 15 out of the last 15 years. About 10 of those 15 years we were at zero. Money was free. And even when they raised it recently, and now it's starting to back off again, even those levels are historically very low levels. If you go back 50 years on that M2 chart, you'll see, even though they raised rates recently, they're still very, very artificially low cost of money. When you have that sort of embedded error, fundamental macroeconomic error being the pricing of money, most essential commodity in any transaction throughout the world or domestically. It's the most essential commodity because when I buy from Mr. A to buy a product and he gets the money and I get the product, He wants to be sure that what I give him is actually got a whole value between now and next year, and and so forth. And if it's changing in value because of the quantity of money increasing drastically in the last 15 years, we've had more money growth than we've had in any other 15-year period, percent-wise, decay in the real value of the money. And then we've had artificially low rates. So that creates errors, individual micro errors, family errors, corporate errors, and they're protracted over a very long period of time. We're not talking about a 2-3 year bull market that's busting. We're talking about a 15-year bull market that went up like 5 times more percent-wise than any prior bull market. And you can say, well, it's a good, strong economy. Yeah, right. It's due to look at the M2 chart. We've been drug infused with M2 money growth and with free money, effectively, for so many years that it's as if we've been administered hallucinogens by the central bank. And so when those errors start to get ripped open and exposed to the wound, and you start to hemorrhage, then it's beyond the control of the central bank at that point to then sort of, oh, we made a mistake. Let's go back and fix it. They always try to. You go back and look at the 2000.com top. They started cutting rates in early 2001 dramatically. All the way down, the market collapsed. NASDAQ went down 82%. Rate cuts didn't save it. 2007 mortgage peak, we collapsed 50%. In S&P, they cut rates all the way down. It didn't stop it from collapsing. So this time around, even though they're going to cut rates, they've already started. Once the stock market peaks, that's historically when you see the data points, the things like they like to talk about. What's unemployment look like? It's factory output. All those metrics that the Fed likes to look at will suddenly go dark. Not before the market breaks, but after it breaks. That's when it occurs. And at that point, the central bank, not just ours, but others, will go into panic mode in unison. They work together. And that will create monetary expansion globally, not just here. And desperation and moves by central banks to buoy their assets they deem worth buoying, like the stock market. The beneficiary of that's going to be primarily the monetary metals. And that's the place to be, especially this coming year. And we've been waiting at MSA for the breakage of the stock market as a key factor in causing the monetary metals to go into the more berserk mode on the upside. Because once that blood starts to come out of that market, it goes somewhere else. Anytime the stock market collapses, the asset flow doesn't disappear. It actually seeks other places. Usually that's T-bonds and gold. This time around, it's going to be primarily gold and related markets. And it's the breakage of the stock market that is the key pending impetus for gold.
In today's news recap, silver price surges to near $29.50 due to increased safe haven demand. Silver price extends its gains for the third successive day, trading around $29.60 per troy ounce during the Asian hours on Friday. This sustained rally is attributed to strong safe haven demand amid persistent geopolitical tensions in the Middle East and the prolonged Russia-Ukraine conflict. Axios referenced 3 sources indicating that U.S. President Joe Biden reportedly explored contingency plans to target Iran's nuclear facilities if Tehran advanced significantly in developing a nuclear bomb before Donald Trump's inauguration on January 20th. These talks underscore the growing concerns over Iran's nuclear aspirations during the transition between administrations. A Financial Times report noted that the People's Bank of China, PBOC, anticipates an interest rate cut this year at an appropriate time. Traders are closely monitoring the potential recovery in China's economy and its effect on the industrial demand for silver. President Xi Jinping reaffirmed his commitment on Tuesday to prioritizing economic growth, promising more proactive policies to bolster China's economy in 2025. While China's manufacturing activity showed minimal growth in December, services and construction sectors have recovered. The data indicates that policy stimulus is beginning to impact certain sectors as China prepares for new trade risks stemming from tariffs proposed by U.S. President-elect Donald Trump. Before we dive into the best clips of the latest interview, make sure to smash that subscribe button and check our pinned comment for exclusive VPN offers. Protect your online privacy with NordVPN, the fastest and most reliable service out there. Just a few clicks secures your data and keeps unwanted eyes at bay. Plus, if you're a stacker seeking truly independent market insights, visit goldsilverstacks.com for our Stacker's Handbook, loaded with strategies to safeguard your financial future so you don't rely on commentators for market insights. Enjoy the episode.
Well, over the last 25 years, we showed a chart going back to 2000 where Bloomberg Commodity Index and the gold were measured against each other. And gold is now back at basically its all-time highs of the last 25 years. There was a period there when gold had doubled in price between its 2015 low and the mid-2020, summer of 2020 high. Went from 1,050 to 2,070, almost doubled. During that same time, Bloomberg Commodity Index was still going down. Commodities were not following gold. And then when gold paused for a couple of years there, it frustrated everyone. Went into a range that was at max 20% wide, but most of it was about 15% wide. Bloomberg exploded. So the Bloomberg versus gold spread collapsed versus gold. So gold underperformed during that period from about 2022 to early 2024. Now has exploded back up again, back to its all-time highs, gold versus commodities. But it's our technical assessment and fundamental assessment that the commodity complex will be a place that exiting money from the stock market will be going. And I don't mean going into corn futures and oil futures, but into stocks related to those commodity markets, like oil-related stocks, base metal-related stocks, agricultural-related stocks like fertilizer and so forth. There will be a place to go. So if you're looking for an alternative place within the stock market, I would be looking at commodity-related sectors, and particularly, I think, ag sectors, agricultural-related, would be a best place. Then there's the issue of the gold miners, the dogs, gold and silver miners. If you go back, we ran a chart a few weeks ago showing the XAU index, which is the Philadelphia Gold and Silver Miners Index. It says miners. And it traces back to 1986, that index. So it's also not an ETF. It's not traded as such, like GDX is. But if you measure that index from its bare low in 2015, coincident with when gold made its low, it's gone up like 120% at current price levels. It's actually, since the S&P, it beats the S&P, but nobody notices this marginally, but it beats the S&P over the same span of time. And yet it's hard to believe that, but you can actually measure it. But when you look at the long-term charts of the gold mining sector, the price charts, but especially when you look at its valuation versus gold, the miners, how cheap are they versus an ounce of gold? Or how expensive are they? Right now, they're on the floor. Okay. And they've been there since 2015. Not been losing ground. The miners have held their ground since 2015 on a percentage basis. They've gone up about as much as gold, if a little more. But they'll accelerate to the upside at some point. And that point will be, especially when people in the stock market say, hey, I got to get out of this thing. I need to buy some other kind of stocks. They're not going to go out and buy gold, silver futures and use leverage, and they're probably not going to use double long ETFs of bullion. They're going to go for the gold miners and silver miners. And since that's such a tiny little sector, and it's so undervalued, not only in relation to gold, but in relation to the S&P, it won't take much money flow, the blood flowing out of the stock market into some other category, to boost the gold miners off the page, because they're such a tiny little asset category. And we expect to see that in 2025, where suddenly the perception that miners are dogs that, lag gold all the time, and they don't. Sometimes they actually lead. People overlook that. But they'll go into a leadership position, and I think that's probably going to be the best place to be on the planet is in gold and silver miners in 2025.
What do you think of today's show? Do you agree with Michael Oliver's predictions about an imminent stock market downturn and the rise of gold and silver? Share your honest opinion in the comments section below. Let us know if you believe the SPX is heading for a major correction and where you see prices landing for gold and silver in the coming months. We're eager to hear your price predictions and how you're positioning your portfolio for what could be a pivotal moment in the markets. Thanks for watching now. Check this episode right here because it's a perfect fit for you, and I'll see you on the other side.